Hello there, I hope that you're doing well. Welcome to episode 13 of the Zeussy Public 2025 Mentorship here on YouTube. This lecture is going to be on intermarket relationship. Let us first define intermarket relationship. Intermarket relationship is the process of comparing markets to determine whether they are moving in tandem. Intermarket relationship lays at the forefront of determining trading environments and confirming anticipated market movements. Please note that I'm putting emphasis on confirming anticipated market movements. We'll get over this in a bit. When intermarket relationship shows correction correlation, it shows you that there's an SMT. Let us first define SMT. SMT is a correction correlation between highly correlated or inversely correlated markets. Meaning, what we're looking at is we're looking at two markets that are either highly correlated or inversely correlated, and we're monitoring whether or not they're moving as they're supposed to move. If they are not moving as they're supposed to move relative to each other, it shows to us that there's a correction correlation which is present, and that is SMT. Now, please note, however, that this is simply a definition which I've just given here. However, the meaning behind the word SMT has multiple meanings according to the inner circle trader. When he dubbed this concept and he came out and taught it publicly, he first said that SMT stood for Smart Money Technique or Smart Money Tool. However, I am of the opinion that the T within SMT stands for Smart Money Time. In advance of every single key market reversal, you will see that there's an SMT present. And therefore, what we can say is that the T within SMT stands for Smart Money Time. It shows to you that the time is right for key market movements, and therefore I refer to as SMT as Smart Money Time. When we pay attention to SMT between correlated markets, we will look at the following definition. First of all, correlated markets should always move in tandem with each other, meaning when one market creates a higher high, the other market should also create a higher high. When one market creates a higher low, the other market should also create a higher low. However, when one market does something different than the other market, it shows you that between these correlated markets, there's a correct correlation. This means that when market 1 creates a higher high, market 2 should also create a higher high. When market 2 instead creates a lower high, this is referred to as SMT, meaning these markets are not moving in tandem with each other. An example of this can be seen below, where you can see that market 1 creates a higher high right here, whilst market 2 creates a lower high right here. This is SMT. When we pay attention to a chart example then, what you can see is that both markets were expanding towards the upside, and eventually market 1 formed a swing high right here. When we however pay attention to market 2, what you can see is that market 2 was also grinding towards the upside, but eventually it formed a swing high, but then a higher high was formed, whilst market 1 created a lower high after the creation of this same swing high. And therefore what you're seeing is that there's a lower high on the left right here and a higher high on the right, and that is SMT. And when you pay attention to the delivery which follows afterwards, you can see that big distribution took place towards the downside on both markets. When we pay attention to a bullish example of SMT between correlated markets, what you will be able to see is that there will be an SMT on the lows which is present. First of all, let us go back to the definition of correlated markets. Correlated markets should always move in tandem with each other. This means that when market 1 creates a lower low, market 2 should also create a lower low. When market 2 instead creates a higher low, this is referred to as SMT. An example of this can be seen below, where I can see that the market on the left creates a lower low relative to the first low, whilst market 2 on the right creates a higher low relative to the first low. The correct correlation which is present between these swing points is referred to as SMT. When we pay attention then to a chart example, what you can see is the following. What you can see is that on the left the market was expanding towards the downside and eventually formed a swing low. Notice that the market then retraced and eventually had one more push towards the downside and took out the sell side liquidity resting below this low. When you however pay attention to the market on the right, you can see that the market on the right also expanded towards the downside. It formed this low and then retraced. Notice that, however, when it eventually expanded lower one more time, it didn't take out the sell-side liquidity, resting below that initial swing low, and it created a higher low. Now we can say that there's a strong correlation between market 1 and market 2, because market 1 created a lower low, whilst market 2 created a higher low. This is referred to as a bullish SMT. Let's take a look at inversely correlated markets. Inversely correlated markets should always move opposing to each other, meaning if one market is bullish, the other market should be bearish. This means that when market 1 creates a higher high, market 2 should also create a lower low. Why? Because market 1 is signaling strength by creating a higher high, so market 2 should signal weakness by creating a lower low. When market 2 instead creates a higher low, this is referred to as SMT. An example of this can be seen below, where I can see that market 1 creates a higher high relative to the first swing high, whilst market 2 creates a higher low relative to that first swing low, and it signals to you that SMT is present. An example of this can be seen below, where on the left you can see that market 1 was signaling strength by creating a higher high, whilst market 2 was also signaling strength by creating a higher high. And that whilst these markets should move opposing to each other. And that correlation is crucial because it signals that heavy price action is likely on the way. Please note that SMT is a confirmation tool, meaning SMT by itself means nothing. SMT is a confirmation of an existing idea which you had already determined, meaning SMT lays at the end of your process and of the process which I'm teaching to you within this public mentorship. Please understand that within the structure of this public mentorship, I'm releasing content in a specific order. When you start paying attention to that order, you begin to see what is the most important and what follows after that new topic which gets introduced. Because you must understand that there's a sequence when it comes to the delivery of price, and your job is to recognize that sequence, and you confirm that sequence by paying attention to SMT. Therefore, SMT is purely a confirmation tool. Keep that in mind. In the execution video which I released prior to the release of this lecture of the 2025 mentorship, what you can see is that I annotated up here that I was bearish for the session of the New York morning session as long as this high remains intact. The high which I was referring to was this high in particular, and the reason why was due to the following. On the chart, what you can see is that I was looking at shorting the Nasdaq. I was looking to trade Nasdaq towards the downside. The reason why was due to the fact that I anticipated that the market would likely expand towards the downside. My mentorship students knew that the draw on liquidity for this week was this blue shaded box on the downside, and that was my objective. Therefore, what I was looking for was the time to be right for an expansion lower to take place. Now, what you can see right here on these highs is that the SMT detector or automated SMT detection tool recognized that there was a strong correlation present between Nasdaq and ES, where I can see that Nasdaq created a lower high relative to this high, whilst ES created a higher high. Meaning, what you can see is that there's an SMT on these highs. This SMT has to last in order for me to remain bearish for the session of the New York morning session. What you can then see is that I put the arrow right here and I shorted the bearish rejection block. Eventually the market delivered towards the downside, and that was the job done. Now, when it comes to this delivery right here, the reason why I'm mentioning this is because what you can investigate is SMT relative to time cycles. Meaning, I taught the time cycles to you prior throughout this public mentorship, and I suggest you to start paying attention to these time-based liquidity pools through the lens of intermarket relationship. What you can do is you can investigate these time cycles by plotting them on your chart and then paying attention to intermarket relationship relative to these time cycles. This process can take quite some time, and therefore we have created an automated tool which helps you with recognizing these SMTs. This tool is called the SMT detector. If you would like to read more about it, you can go to smtdetector.com and you will be able to read all the details there. I want to thank you for watching this episode all the way to the end, and I look forward to speaking to you in the next one. Be safe!